Hello and welcome back to the ROI channel, the channel that's obsessed with the art and science of return on investment. And today it's a stock analysis. It's one that's made public. It'll be in the publicly held portfolio. Following on from my conversation with Stephen Farrington, I'm going to give my take on Profrac, what I think it's worth, and how I could make potentially some money out of this. Big thanks to the new subscribers and commenters. There's a great comment saying that Amid 1991 likes the content and feels that I don't get the recognition that I deserve. So all we got to do, guys, is subscribe and spread the word. So I appreciate that. Hit the subscribe button, hit the like button if this is of any value to you. It doesn't cost you anything, but it does help me out a lot in terms of motivation to put my time into making more of these videos as opposed to some of the other things that I get up to. Another thing they get up to is managing the Crassus investment portfolio. There is a publicly available portfolio on eToro that you can check out. A link will be in the description. Okay. Disclaimer, I'm not a financial advisor. I don't know your situation, anything like that. So please, all I'm doing today is giving you my take on things and documenting my opinions with the world. They change and they are subject to change without notice necessarily. So please do your own due diligence, caveat emptor. But I think if you go back and look at some of the previous takes I've had on things, things tend to be useful and work out over the long term. So let's get to it. Profrac. I won't spend a lot of time giving the history of the company because that's available on the channel. You can go and look at my interview with Unemployed Value DJ Steve Farrington, where he covers it very, very well. So, vertically integrated energy service. Over the last 2 years, they've spent almost $1 billion, or around $1 billion, in buying up related businesses. They're doing a roll up to operate in the oil services space in the shale basin. So, it's an onshore shale company. The thesis in a nutshell again is the shale growth is starting to slow. We're going to eventually get to this point where it rolls over in order to extract more and more hydrocarbons for which there is inelastic demand. So we're going to continue to have constant demand over the longer term for the hydrocarbons. The shale basin really are the swing producers now. The world will be looking to them to be able to supply the market. And in order to get more and more in order to get the same amount of hydrocarbons as in the past, you will need to spend more and more in capital expenditure. And that is going to be the revenues, or is becoming the revenue and profit of businesses like Profrac. So it's been smacked over the last year. As Steve mentioned, this is because they tried to transocean and they tried to hold the line in terms of price, believing they had more market power in terms of their frac vehicles. So they own frac trucks. They said, no, we're only going to accept a certain amount of rent in terms of prices to rent out their trucks. That didn't happen. And so they had a few utilization issues, meaning they had a few Profrac trucks that were not being utilized. So the market's punished them. It's been walloped down 60% over the last year. And whenever I see a chart like that, I like to take a bit of an extra look just to see what's going on. The company one pager looks like this. A few things I'll point out. First of all, like 2.5 times the free cash flow is ridiculous for a $1.1 billion company. It's pretty insane. You could buy local businesses here where I am for maybe 2-3 times, 1 times if you're really lucky. But to be able to do something on this size, I think is a tremendous opportunity to get it at a discount to both its asset value and its free cash flow. So here we've got price to book 0.9. But as you'll see in a moment, I'm going to break it down for you. I think it's more like half of that if you look at the new build cost. So we've got a lot of things starting to line up and come together. In a nutshell, the investment case is that Profrac, I believe, is an underappreciated onshore oil service company holding 45 frac fleets and several strategic advantages, thanks to its roll-up and vertical integration strategy. Its replacement cost sits at about twice the market cap, or 1 times the enterprise value, and it's likely to generate that market cap in EBITDA over the next year to year and a half. Looking at a little further, at peak cycle, management estimates an earnings power of approximately 50 million per fleet, which would be equal to the entire current enterprise value and conceivably offer a 5 to 8x return from the current price. The assets. Let's break down the assets in terms of a starting point for evaluation, as I like to do. How much do these fleet trucks cost to build new today. And so you've got diesel powered and you've got electric vehicles or electric frac fleets. It's a tough word to say. So let's use the estimates as best I could come up with, times it by the number of fleet that they have. Okay, so if you were to value them at diesel powered fleet, it's about 1 billion to rebuild this company's fleet from scratch today. The electric vehicles, 2.25 billion. Okay, to rebuild it from scratch today. So pick your number, midway point, 2 billion, there or thereabouts. It's not supposed to be a precise science. It's supposed to give us a rough ballpark to see if further investigation may be warranted. And I believe there is. Let's say 2 billion or even 1.8 billion. That's a long way north of where the current market capitalization is on this company. So let's look at EBITDA and do a very rough back of the envelope calculation. So we're confident about the macro thesis, the meso thesis, and where this is all heading. Let's say at current guidance of about 20 million per frac fleet across the whole fleet, divided by the shares outstanding, you're looking at about $5.6 of EBITDA over the next year to year and a half. Okay, that's an earnings power that the company can comfortably achieve, I believe. You've got 4 times EV to EBITDA multiple on there. I don't think that's particularly egregious, which, crazy as it sounds today, would suggest somewhere in the mix of a three-bagger. So $22.50 up from today's current price. That might be 300% upside. But maybe it doesn't take as, maybe it takes longer than you think. And in my case, I always tend to be early. So no problem. If it takes us 5 years to realize this thing, okay, with all the frustrations and ups and downs of people commenting in the Discord and wondering if everything is okay, if the thesis is solid and it took 5 years to play out as I've described, albeit in a very quick and dirty fashion, you're looking at a 32% IRR, okay, which is above my hurdle rate personally. I'd be very happy with that. Considering the debt levels on this thing are just fine, the management owns about 70% of the entire company. They are incentivized to perform. In the Super Bowl scenario where we get to that point in the cycle where it's drill, baby, drill, there's a lot of capex coming into the sector. Management believe that alone, just on the frac trucks, they can pull in about 50 million per fleet. That would suggest about $14 of EBITDA per share based on the current share count, of course. And the market would surely be willing to pay somewhere around 5 times that EBITDA. And I think, given the history of this management, what they would do is sell to a bigger company. They have a history of doing that successfully, and I think they go through, they continue the roll up that they're doing. They get some tailwinds from the market picking up in the oil services sector, and all of a sudden that becomes attractive. Probably, I'm not thinking to private equity. I'm thinking to more of perhaps a major. Could be wrong. Who knows? They come in and they acquire the company, and the Wilks just cash out, and they're all happy. So I don't know if and when this is going to happen, but let's say something similar to this can be achieved, and this is only using their EBITDA guidance in this scenario. You get $14 of EBITDA per share. 5 times multiple certainly doesn't seem outrageous, and you're looking at a $70 stock. Okay, from the current price, it's basically a 10-bagger. And even if that takes 10 years to realize, it's well above the hurdle rate at 26% IRR. So a few things just to comment here. When you do roll-ups, okay, and I've done this, you're always watching your debt service coverage ratio is what you're really looking at month on month, not your debt to equity and all that stuff that people talk about. That's rubbish. Every month, can you meet your obligations? That's what you're always living and dying by. So a metric for this would be EBITDA minus CapEx in this case, because they have to continually reinvest in maintenance and whatnot, divided by their interest expense. As a commercial lender, that would need to be below 3 to be comfortable. That was my rule doing roll-ups. I needed to keep that to being 3. It's below 3. So happy days, right? Given that they've already taken on all this debt and now they're really starting to pump out some cash. The EBITDA margins are never going to be that great, so I'm not particularly worried about that. But they're still reasonable for this type of business. So Their cash from operations, just here on the right, you can see the line listed there for their acquisition. So over the last couple of years, they've been on a spree, and that seems to be slowing. And they seem to be happy with their vertically integrated structure. This is important because they sell the proppant, which is the type of sand that goes into the cracks when performing the hydraulic fracking. And three-quarters of the sales from that segment of the business actually doesn't go to them. It goes to their competitors in the space. So they've got a very diversified business. They've got the synergies from spending this money acquiring related businesses. They can reduce the SG&A expenses. And so I think you'll see impressive revenue growth as well as improvements in said margins. There's lots more I can say. I may do a full write-up on this company, but I think Steve covered it really well. My thesis on the stock is I'm long the stock. I've only started to inch my way into it in tranches. Multi-bagger potential, definitely. It's got the liquidity, okay? It's got solid management with an accretive track record for doing this type of thing. There is some risk. I mean, you can have a delay to the thesis, certainly, and commodity investors are well used to that. But if you've got a bit of patience, there's a catalyst for their re-rating, being that they're willing to take lower prices to improve the utilization of their rigs. And if the Permian is rolling over, they're going to need more and more of these guys operating. In addition to which, AI using the amount of natural gas that it does, I think these guys could be an example of a company that's set to benefit from the increase of natural gas demand in the US and also the new um, terminals and processing facilities that are coming online with regards to natural gas exporting from the US overseas. I will be looking to make it three, perhaps a 5% max. I originally was going to keep it to a smaller position, but look, I mean, the thesis is there. And if you're looking at other positions in the public portfolio that are around that sort of 3 to 5% mark, I think that this stands up as a good an opportunity as any of them. And probably, I'm thinking of Vital, which is around that 5% mark now. I believe in the re-rate for Vital, but I would have more confidence in a management team behind Profrac. So keep an eye on the portfolio. Ask me questions in the comment section. I'll keep you updated as best I can with what I'm doing. Thank you very much for watching. Please do like and subscribe, and I look forward to seeing you in another episode shortly. Take care.